On the 11th of August, Australia got the monetary policy version of Seen No Reply. The RBA left the cash rate at 4.35%. No hike, no cut, and somehow your banking app still did not send flowers. So if nothing changed, who really benefits? Confirmed facts first. The decision was unanimous. The RBA has raised the cash rate 3 times in 2026, then held it in June and again in August. It says headline inflation is still too high, while trimmed mean inflation remains elevated. It also sees signs that consumer spending growth is slowing, housing prices are falling in some capital cities, and new housing loans have declined noticeably. The cash rate is the overnight rate between banks, but the RBA says it strongly influences lending and deposit rates across the economy. Important word, influences. It is not a remote control. Competition, financial market conditions, and the risk attached to different loans can also affect the rate a bank offers you. WRB's view is this: a hold is a pause, not a relief package. Borrowers were spared a new cash rate increase from the RBA that day, but many variable rate borrowers still face the existing cash flow pressure. People with interest-bearing deposits may keep benefiting if higher rates are passed through to their savings. Businesses that rely on debt also keep facing tougher borrowing conditions. And banks? The honest answer is not automatic win. The cash rate affects lending rates and deposit rates, while competition and risk also matter. The cash rate number alone cannot prove which bank made more profit. That answer needs actual bank data, not vibes wearing a tie. Here's the catch. The pressure is uneven because that is how monetary policy reaches the economy. Higher rates are intended to cool spending and demand, but the RBA says the timing and size of the effect are uncertain. The serious counterargument is that holding may be the least bad option while the board waits to see whether the earlier increases are working. Inflation remains too high, yet parts of spending and housing are already slowing. That is a fair case for pausing. It does not make 4.35% neutral. The next scheduled cash rate update is to 29 September. The watch items are inflation, spending, housing, and the labour market. The RBA says inflation is not expected to return to around the midpoint of its target until late 2027, and it could raise the cash rate again if upside risks materialise. The takeaway is simple. When the headline says no change, separate the new shock from the pressure already in the system. Borrowers got no new RBA increase that day. Some savers may retain higher deposit returns if banks pass them through. The wider economy keeps absorbing the existing setting. Which is biting your budget more right now? Loan repayments or everyday prices? A hold is still a choice, and 4.35% is still doing the work.